Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zaegel, and this episode is brought to you by CWOs for Hire, which is the financial planning firm that I co-own. This time of year, we are bringing on new clients, so if you're looking for help or just have questions, please feel free to reach out to us at cwosforhire.com. Let's chat about some large funds and different investors, because it's important to understand what they are doing and when we should pay attention or not. We'll often hear about, well, this fund is doing this, or this private equity company is doing this hedge fund's doing this, or Berkshire Hathaway is doing this, Warren Buffett's doing this. All this stuff around, look at what these big investors are doing, with the implication that you should be doing this too, or you're an idiot. And that is not how this works. So I want to make this clear that we should not always be looking at these large funds and trying to mimic what they are doing. Now, it's good to look at what they're doing and maybe ask why. Is there a reason behind it? Is there something we should be looking at it there? But just making an investment because another big fund or another big investor is doing so is madness, especially when you consider the fact that they are really playing a very different game than an individual investor, especially one trying to retire or one who is in retirement. I'll use a sports analogy. The game that big funds are playing are more often akin to playoff matches. So things that are a little bit more short term. That's not always the case, but there's going to be more of a short term focus. So, and sometimes in sports, there's a sudden death playoff. Other times in baseball or hockey, maybe you'll have a 7-game series over, say, around a week and a half for this thing to be resolved. But that's still very short term. Even the 7-game series is pretty short over a week and a half time span. Whereas as individual investors, especially with retirement planning, we're trying to plan for a whole season. That's much different than trying to win in a compressed period of time. A lot of times, large funds, they're looking at what is their quarterly performance, what's their annual performance. Even oftentimes, maybe in private equity funds, when they come in and make an investment in the company, they want a return within, it's going to vary, but let's say 7 years, 10 years, sometimes shorter, sometimes a little bit longer. But even then, it's a much shorter time frame than what we are using for retirement planning. So why in the world would we try to match exactly what a big fund is doing when they're looking at quarterly, 6-month, annual results, and we're looking at results over 20, 30, 40 years? And again, it's not to disregard what those companies are doing, because there may be a reason why they are doing it. But it's really important to find out what that reason is. And we don't always know. We often don't know what that reason is. We can't just blindly follow this investment because so-and-so did this. We have to match it against what we need for retirement planning. We need to set up a proper structure. We talk about all the time, 5 years worth of income, at least, in individual bonds, structured notes, CDs, that have set maturity dates. That's for our short to medium term income. The rest of it can be growth focused. And sometimes we can use the investments that the larger funds are making if there's a good reason to do so. But we can't just say, oh, well, this hedge fund is investing in this investment, therefore we should. That might not fit anywhere in the risk that we need for this growth bucket. And if we hear about, I have nothing against Warren Buffett or Berkshire Hathaway, but this is one that we hear all the time. well, Warren Buffett's buying this or selling this. And by the way, when you say Warren Buffett's buying this, it's usually not him. Maybe it is, but it's probably other people at Berkshire Hathaway, which is fine. But they are really playing a different game. And it's a good game, but they're going to come in a lot of times and buy when things are crazy cheap. They were there in the COVID crash offering loans with warrants and really good terms for Berkshire Hathaway, which they should do. This is a good thing. But we have to just understand that they are playing a very different game than what most investors will want to play, especially when they're talking about retirement planning. So totally different goals, totally different ways of going about things. Ultimately, it's always to try to make money, but you have to understand what your risk profile is, what your timing is, and plan around these things appropriately. When we're doing retirement planning, all the stock investments are focused on the long term. So whereas a fund might be focused much more short term, like we just talked about, they're the playoff teams, they need to win now. Our stocks, our investments are not focused on that. It's good if we can grow them in the short term, but really they are focused on long term, 5+ years, not 5+ months or even 5+ weeks, 5+ years, because we have 5 years worth of income already set in individual bonds, CDs, structured notes that have maturity dates to provide income, and they are safe. The rest of it is focused much more long term. So next time when you hear about such and such fund is doing this or somebody's doing this, that can be good, but we need to pause for a second and say, does this fit what we are trying to do? Does it fit the game we are trying to play for retirement planning? If it does, great. If not, don't worry about it. There's thousands of investments out there. You don't have to get every single one perfect. There's a lot of things to invest in. Don't get too hung up on what the big funds are doing. Thanks so much for tuning into this episode. I really appreciate your support and hope you found value in the conversation. If you enjoyed it, be sure to subscribe, leave a review, and share it with someone who might benefit from it. Your feedback helps keep the show growing. Until next time, take care and stay strong as we learn